US consumer is feeling pretty low on the economy. Latest data confirms India's growth story and why I cashed out of Microsoft. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. Feeling much better now compared to last week, where I literally, had lost my voice and didn't know where I was going to do the episode. Feeling a lot better, well rested week, and I'm feeling back to not 100%, given the fact that the weather in UK is going up and down, massive fluctuations which have been affecting, but nonetheless back with a new episode, back with my voice fully restored, and let's get started now. It appears that even a much better than expected inflation just can't keep the bears at bay. I mean, it did for about 24 hours before the sell-off resumed. And it's not just the bears, the US consumer as a whole is feeling pretty low these days as fears of a recession are dragging down their confidence and along with it, their hopes for the future as well as their ability to spend. So in other words, the whole rosy picture that we had about the US economy a few months back just seems to have vanished into thin air. Before we get into the details about that, a quick recap of the markets. The week started off with the year's biggest sell-off, and I gave you a little bit of hint to that last episode when I recorded on Tuesday, and that was more than enough for the markets to end the week on a 4-week losing streak. Bears were in full control once again. Dow slumped 3.1%, S&P 500 tumbled 2.3%, and the tech-heavy Nasdaq slumped 2.4%. So without further ado, let me quickly welcome you to the Doctor's Weekly Snapshot, take you through all the major developments of the US markets last week. Spoiler alert, a lot of tariff talk will be there. I mean, when the markets have been they're hypnotized by the whole tariff picture and the tariff uncertainty. What else can the stock doctor talk about, right? Because my job, my main role, my main goal is to give you the action that took place in the markets and what to make of it. And if tariffs are driving the whole thing, well, we talk about tariffs, but not just tariffs, though. We're going to have a lot more to discuss. A lot more to discuss in addition to tariffs this week. Now, I'm going to start off by saying the US consumer is in a pretty bad shape. And I'm not talking about capital-wise, I'm not talking about physically, but I'm talking from a pure sentiment perspective. The US consumer looks completely devoid of confidence when it comes to the US economy, as President Trump's tariff uncertainty, first mentioned in recent days, have ratcheted up the possibility of a recession. At least that was what the main takeaway was from the latest consumer sentiment report that we got last Friday. Now, according to the latest sentiment data, the University of Michigan's Consumer Sentiment Index fell by a whopping 11% to 57.9 in mid-March from 64.7 last month. So 64.7 to 57.9, pretty big drop. This marks the lowest level since November 2022 and came in well below economists' expectations of 63.2. I mean, either that's poor estimation or things have deteriorated pretty bad. 63.2 was your expectation. Actual number 57.9. Clearly, your projections are all over the place. But I'm going to give them the benefit of the doubt, given the fact that things have declined pretty fast and a pretty dramatic fashion, that I'm pretty sure it'll catch most economists off guard. So I'm going to give them the benefit of the doubt this month. Either way, actual figure way worse than what was expected. On a year-over-year basis, the drop from 64.7 to 57.9 translates to a drop of 27%. Now, the decline is attributed to the uncertainty around economic policies, including, well, no surprises, tariffs, second mention, government layoffs, funding cuts, and immigration restrictions introduced by the Trump 2.0 administration. Recent stock market fluctuations with the S&P 500 entering correction territory, that's right, correction territory in a matter of weeks, have also contributed to consumer unease. And in a week where the inflation report was a lot better than expected, more on this in a bit, the US consumers' inflation expectations actually continue to remain elevated. They didn't care about the current inflation report. It simply was more elevated. Now, inflation expectations right now have risen to 4.9% as things stand from 4.3% last month. And the 4.3% last month itself was super elevated. So the fact that it got elevated from 4.3 to 4.9, it's not a pretty picture. And it's the highest expectations since late 2022. What was worrying was that the sentiment declined across all age, education, income, wealth, and geographic regions. There was absolutely no discrimination, absolutely nothing to make of like, oh, the younger population is thinking about this, lower education, or higher educated people are thinking like this, lower income consumers are thinking like, nope, across the board, the sentiment was simply bad about the US economy. Now, the sentiment, what is very surprising, not surprising. What is very funny, what is very intriguing is the fact the sentiment data, no matter how dramatic and how eye-popping the numbers are, should hardly come as a surprise to investors and economists. In fact, the projection, this is why I say I'm giving the benefit of the doubt to the economists. It should have never really come as a surprise. They should have never, that projection figure should never have stayed at 63.2 when the actual number, it should have been far lower than that. It's because if one really takes a look at the recent spending levels and patterns, then it would become very clear that the US consumer is more into savings mode rather than the spending mode. Spending has decreased across all income groups, affecting both necessities as well as luxury. So it's not like, I'm going to cut down on discretionary spending, which is what we saw last year, where they cut down on discretionary spending, focused on essentials. No, now it's a matter of fact that, if you really need it, we're going to buy it. If we need it, but not really need it, we're probably not going to buy it. Luxury, forget about it. So it's that kind of an environment, which is not necessarily great when you come to think about it from a company perspective, as well as from the overall economic growth perspective, right? I mean, of course, why is this happening? It's again attributed to concerns about tariffs. There we go. Third mention, inflation and a potential recession. I mean, when a US president says, refuses to rule out a recession, what chances the U.S. consumer, can you really blame the U.S. consumer for thinking a recession is imminent or recession is, it's about to come? I mean, no, not particularly. Moreover, retailers are also experiencing weak demand since the start of the year. Even food sales have seen declines, as evidenced by Citigroup's analysis of U.S. credit card data. And if one really looks at the earnings call of some of the major retailers, then the pattern becomes even more clear. For instance, low-income consumers are showing stressed behavior, such as buying smaller pack sizes at the end of the month due to financial constraints. Where do we get this information from? It was from Walmart's earnings call. Walmart CEO noted that these consumers' money often run out before the month ends, and therefore they are now resorting to smaller size packs. It was further evident by the latest report from Circana, which found that convenience store sales in the US fell to 4.3% year over year in volume. A further sign that consumers are becoming more price sensitive. They were already more price sensitive last year. They're now even becoming even more price sensitive and are simply less willing to splurge on non-essential items. McDonald's reported a sluggish start to the year, partly due to weak demand from lower income consumers. Sales to this demographic were down by a double-digit percentage in the fourth quarter compared to the previous year. And that's why the whole overall sales of McDonald's took a beating. By the way, McDonald's has been doing a great value deals and so on. Just doesn't seem to catch up, at least in the lower income bracket. There is a lot of saving mode rather than spending mode, and an absolute necessity spending mode rather than spending on even things that might be necessary. But if they can push it back, they push it back. Dollar General's customers are prioritizing basic essentials and sometimes sacrificing even necessities. The company simply does not expect economic conditions to improve this year, as was very evident from the management's take during the earnings call. Now, it's not just the lower income consumers whose spending levels have dramatically declined. If you take a closer look at luxury spending, and you'll see that the pattern has moved to the higher income consumers as well. Now, Walmart was shielded from the fact a lot of higher income consumers had moved to Walmart for their shopping and it was doing well. Now, luxury spending was already bad. It's now gotten worse. Spending on luxury items fell 9.3% in February compared to previous year, following a 5.9% decline in January. So 5.9 was bad. As the month progresses, it just got significantly worse, nearly double of that of January. So 5.9% year-over-year decline, 9.3% year-over-year decline in February. This indicates that higher income consumers are also becoming cautious. Costco members are shifting towards lower cost options like ground beef and poultry. And while they continue to spend, they are being more selective about where they allocate and what they allocate money to and where they allocate their money to. And last week, even airline stocks suffered a beatdown after the airline companies such as Delta, American, and JetBlue all cut their Q1 guidance. If you simply look at Delta's case, that just shows to you how much investor positivity was there, and it just got that bubble, that positive bubble, simply burst. I mean, it was down 14% after the cut the guidance. I mean, it was crazy. And the reason that all the airlines cut their guidance, Q1 guidance, was because they cited weak demand, a further sign that there is broad economic uncertainty in the US as things stand. While it didn't create a lasting cheer, at least there was one bright spot last week, and that was the latest inflation data. More specifically, in February 2025, the CPI, the Feb CPI, showed that inflation cooled to 2.8%. Finally, we get a two handle. Guys, finally, we get a two handle. A bit of round of applause for the inflation report. Problem is, just didn't matter towards the end, last 24 hours. All the applause and the happiness last 24 hours before sell-off resumed. Anyway, 2.8% was better than expected 2.9%, and it also represents a decrease from the January's figure of 3%. The core inflation rate, which excludes food and energy prices, was 3.1%, so close to the two handle, but nonetheless, it was lower than the expected 3.2%, and it marked the lowest year-over-year reading since 2021. Shelter costs, a significant source of inflation, rose by 4.2% from a year earlier, the smallest gain since December 2021. This reflects a lag in the Labor Department's measure of shelter costs, which is only now capturing a previous slowdown in rent inflation. Egg prices. Yeah, you heard it right. I'm not making this up. This is a finance show, but I'm talking about eggs. Yeah, egg prices, however, are now starting to have an impact on the overall food prices, as evidenced by the 2.6% year-over-year rise in this particular metric. To give you some context about the egg prices, the price of a dozen grade A large eggs, it reached a record high of $5.90 in February, and that's up from $3 a year earlier. Now, there was a very interesting article on Wall Street Journal that I read last night. I'd already prepared for the podcast script, but I still thought I will share it with you, that now Americans are even attempting to smuggle, yep, you heard that right, smuggle eggs from the likes of Mexico and Canada, where prices are nearly a third of what it sells in the US. Yeah, we talk about drug smuggling, we talked about a lot of other kinds of smuggling. Eggs are now being a target for people to smuggle. Now, I mean, never thought I would say this. Never thought I would say this in a show that goes on a YouTube channel or on a podcast show. Never thought I would say this, but that's right, guys. People are now smuggling eggs. That's how bad it is. Right. Gave you a lot of data, but what do we really make of this, right? What do we really make of this? Now, more importantly, for you guys and me, what would the Fed make of all of this in its upcoming meeting scheduled to take place today and tomorrow? Now, it's a two-day Fed meeting. We'll probably get something from Fed Chair Jerome Powell tomorrow. Stock Doctor will definitely be talking about it in the next week's episode. So don't worry, even if you've missed it, I got you guys. All right. First of all, let's get real. Things are uncertain. There's no doubt about that. The problem with uncertainty is that it brings a lot of fear into the mix. In fact, in my opinion, maybe it's controversial, maybe it's not. But if things were downright negative, I believe the sentiment would be slightly better than what we have today, since at least there is a certainty and at least there would be some roadmap as to when things would pick up. But unfortunately, right now, things are so uncertain. We don't know whether we get a recession. We don't know how deep the recession is going to be if we do get it. We don't know whether it's a slowdown. We don't know when inflation will get to that two handle. We don't know what the tariffs are going to do. Are they going to raise inflation? In that case, to what extent will inflation get, right? It is uncertainty. Nothing instills fear into people's minds than uncertainty. So probably not controversial when I say if things were downright negative, sentiment would slightly be better. But things are not. Things are extremely uncertain, and therefore the fear is also extremely high. And that's what's being witnessed in the US economy as the consumer goes into the super extra cautious mode and focuses more on saving than spending as they all anticipate a recession, whether it's imminent or not. They're expecting a recession. Sometime this year, they're expecting a recession. Is the US consumer right to develop this fear? Of course. Why? Because of the uncertainty. Now, I cannot stress this word enough. It's uncertainty. It's the lack of clarity surrounding the nature and the timeline of President Trump's tariff policies. Again, it's not the actual tariffs, but rather the uncertainty surrounding what shape these tariffs would take and how would other countries retaliate that's led to this particular fear. To be honest, President Trump has not made this easy at all as he has adopted a zigzag approach to the tariff policies. One moment it's 50% on Canadian imports, 200% on European liquor, 60 minutes later back to the original 25%. The goal behind the tariffs also remains unclear. Is it simply to stop illegal immigration, stop the transport of illegal drugs such as fentanyl, or is it to make the United States manufacturing powerhouse? Simply no clarity. 50% tariffs on Canadian imports, back to 25, 60 minutes later, 200% on European liquor. It's too much uncertainty, guys. President Trump has said that it's probably, he's doing all these tariff policies to make the US a manufacturing powerhouse. But again, the dilly-dallying has raised more questions, even with regards to this particular goal. It's not like a flicker switch, light goes off, fantastic. Flicker switch back, light goes on. Man can't do that the same with manufacturing and supply chains, can you? You can't just switch a flicker and supply chain becomes better. No, it takes time. And if you're going to bring in uncertainty to tariffs, brings even more brings even more pain the companies as well as by extension to the consumers of the products of the companies. Now, no matter the magnitude of tariffs, if they are there is a high risk of an inflationary environment, and that's why the bulls barely got any breathing space after last week's inflation report, as after rejoicing the data, reality definitely kicked in when investors started to consider the potential impact of tariffs and other economic factors on future inflation. Nobody cares about the present anymore or the past. It's done. We care about the future. To be honest, investors do have a point, and this is exactly what the Fed is also likely to do. It's a data dependent Fed, but the data on which it is dependent on but the day has been plagued with uncertainty and noise, and it's all over the place. How on earth can the Fed cut rates at this point in time when it simply can't predict with confidence how the shape of the inflation curve would be? Sure, the labor market remains strong, and the Fed can point to this while it pauses rates, but the labor market data is not accounted for the potential job losses as a consequence of Doge's activities. This is not a political show. I'm just merely talking about policies here. Yeah, I don't care which party you support. I don't care who you support. It's a matter of the fact that I'm talking about policies and not politics. All right. So I'm just saying, consequence, the moment I hear Doge's effort, I know that I'm going to get some flack for it for yes or no. No, I'm simply saying Doge's efforts could lead potential job losses could happen as not factored into labor market. End of story. In short, things are looking extremely uncertain, and with a potential tsunami of reciprocal tariffs about to hit the global economy on April 2nd, there is absolutely no chance that the Fed would pencil in any rate cuts for the foreseeable future. In fact, I would expect a tone filled with more uncertainty than confidence when Fed Chair Jerome Powell steps into the podium for his press conference on Wednesday. Up until a few weeks ago, here's the funny bit. Up until a few weeks ago, the impossible feat called soft landing was within the Fed's grasp. Now, while I'm not saying the promised land has disappeared, it sure as hell got a whole lot complicated to get there. And if the Fed finds it complicated and confusing, can you really blame the US consumer for feeling the same? On that note, let's head to the next segment. Doctor goes home. And first of all, I know I've ended the last segment on a pretty grim note. So let me start off the next segment on a positive note. A belated happy Holi to all my Indian listeners. Okay, I know Holi was on Friday. Really, really belated happy Holi. I really hope you guys had an amazing time with your family, celebrating with a lot of dance and colors. Saw some YouTube reels, saw some Instagram reels, saw some Facebook reels of my friends celebrating and having a blast with Holi. I hope you guys did the same. And if you are a long-term investor, Then the Indian economy did bring you a lot of holy cheer last week as a flurry of economic data that suggests that the Indian economy remains on a very strong footing. And if you factor in the inflation data that came out last week, then in the coming weeks, coming months, growth is expected to receive a solid boost from RBI courtesy of more rate cuts. So happy holy it is, not just from me, but from the Indian markets as well. So let me take you through the developments that took place in the Indian economy, starting with the February inflation data. Retail inflation in Feb reached a 7-month low, reaching 3.6%. It was the lowest level in 2 years. 3.6%, back below the RBI's target of 4%. Brilliant. Primary target, as expected, was food inflation, which hit a 21-month low of 3.8% in Feb, and it was down from 6% in Jan. Vegetable inflation, which are a subset of food prices and have been driving the overall food inflation in recent months, declined by 1.1%. You remember a few months back, I said 27% rise, 15% rise, all that over dramatized numbers, which tend to be, which are nothing but, which were not over dramatized at all, but was reality. They've now declined by 1.1%. Happy holy again. Keep in mind that in recent months, I told you they've been jumping double digits. So decline this metric is very much welcome news for the overall inflation picture. Now, if one looks at the regional inflation, then rural inflation had a sharp decline, coming in at 3.8% in Feb compared to 4.6% in Jan, reflecting a more pronounced decline in rural areas. Urban inflation had a slower decline compared to rural inflation, although a decline of to 3.3% from 3.9% is yet another welcome relief. Overall, it was an absolute blockbuster of an inflation report as far as the long-term bulls are concerned, since it does suggest that they can now expect more rate cuts from the Reserve Bank of India. Economists also believe that the decline in inflation increases the likelihood of yet another rate cut by the RBI's Monetary Policy Committee when it convenes from April 7th to April 9th, so about 3 weeks from now. This would follow the first rate cut in 5 years, which occurred in Feb when the policy rate was reduced by 25 basis points to 6.25%. Can we expect another 25? I would expect so. Can we expect another 50? Don't rule it out. When you combine the potential rate cut with the liquidity measures that the Reserve Bank of India has been working on to ensure an easy flow of liquidity, then long-term investors can definitely be happy knowing that there are enough stimulus measures at play that should keep driving growth in the coming months. Now, in addition to inflation, there were more signs that showed that the Indian economy had course corrected and was on path to be the third largest economy by 2028, as suggested by Morgan Stanley in a report last week. India's industrial production, for instance, grew by 5% in January, marking a positive trend in the country's manufacturing and production sectors. This growth is an improvement on previous year's performance, where industrial production grew by a much lower rate. When you look at sectoral performance in the manufacturing sector's output was what really stood out compared to some of the other sectors. The manufacturing sector's output increased by 5.5% in January compared to 3.6% in the same month last year. This significant increase in manufacturing output is a key driver of overall industrial growth, indicating a robust performance in this particular sector. The fact that improved industrial production can lead to increased investment and employment opportunities bodes well for the overall economic growth. In addition to a strong industrial output driven by the manufacturing sector, the higher government spending in January also saw a positive impact, supporting industries like petroleum products, capital goods, and consumer durables. Notable year-over-year growth rates of 8.5% for petroleum products, 7.8% for capital goods, and 7.2% for consumer durables. In short, the twin tailwinds of a reduced inflation and increased output demonstrate how the structural growth story of the Indian economy has been intact, something that I've been telling you repeatedly over the past few episodes. If you don't believe me, now the data, if you didn't believe me back then, the data clearly backs up now. And the path taken by these two metrics do not involve any unwanted surprises. In the short term, however, the path taken by the foreign institutional investors remains the same, which is that they continue to be net sellers as the global macro uncertainty remains. In fact, 2025 has turned out to be the worst year when it comes to FII selling. In the first fortnight of March has already touched 30,000 crores. The overall selling this year has reached 142,616 crores. No small number, guys. This is hardly surprising since we still don't know how the reciprocal tariffs, the one I mentioned about earlier, set to hit on April 2nd, are going to affect India. There have been positive news coming in from both Indian and US officials regarding the progress made in the long overdue bilateral trade agreement, but the constant finger pointing at India by President Trump and more recently by Commerce Secretary Howard Lutnick does suggest that India is simply not out of the woods yet when it comes to reciprocal tariffs. Any significant changes in global trade could impact future growth rates in the sectors that I mentioned earlier: petroleum products, capital goods, manufacturing, and so on and so forth, which would subsequently affect the future industrial output. I really think investors are jittery despite the strong economic data because of a lack of clarity on the tariff front. How many days? Is that the 10th mention of tariffs? I did tell you it's going to be a tariff-driven week. April 2nd is when we'll really know where India stands. And I think that's when we'll probably get some clarity on the direction that markets would take for the foreseeable future. Having said that, as a long-term investor for which the show is made for, I wouldn't lose too much sleep over what's happening in the markets now. The time to accumulate beaten down names is now, according to me, and the latest economic data just proved that. The long-term growth story remains firmly intact, ladies and gentlemen, and no amount of short-term uncertainty is going to change that. On that note, let me welcome you to the final segment, the Doctor Dissects, where Microsoft makes a comeback and goes under the microscope. Now, the Mag 7 has taken a battering in recent weeks in the stock market, so I figured it's the perfect time to start analyzing some of the major names. And I'm going to start off with a disclaimer. I mean, you would have probably got the hint from the title. I have cashed out of my Microsoft position. I no longer own any shares of Microsoft. I'm out. Should you be also out? We're about to find out. Getting the book ready for the valuation, by the way. Now, Microsoft reported its Q2 earnings last month, and if one looks at the big picture, then it had a pretty solid quarter, beating on both the top and bottom lines. More specifically, Q2 revenues came in at $69.63 billion, up 12.3% year over year, and beating analyst estimates by $823.1 million. Diluted EPS of $3.23 was up 10% year over year and beat analyst estimates by 11 cents. Operating margins after declining year over year last quarter were on the rise again, jumping 2% year over year, coming in at 45%, which demonstrates once more how the company continues to remain efficient despite its massive AI-driven spending. The guidance, however, was soft, which can be attributed to a strengthening US dollar. Having said that, the dollar has now started to weaken again. So again, these currency fluctuations tend to create some uncertainty with regards to overall guidance. So take it with a pinch of salt. More specifically, the strong dollar is now expected to result in a 2% year-over-year decline in revenues. Furthermore, revenue growth in its cloud division, Azure, is expected to be between 31 and 32% in constant currency. Cost of goods sold for the third quarter is expected to be between $21.65 billion and $21.85 billion, which translates to a growth between 19 and 20% in constant currency. Operating expenses are expected to come in between $16.4 and $16.5 billion, and other expenses are projected to be approximately negative $1 billion. Effective tax rate for third quarter is projected to drop to approximately 18% from 19% in second quarter. And finally, the elephant in the room, as they say, which is the CapEx spend, is projected to be at the same levels as Q2, both in third quarter and fourth quarter. Now, I'm not here to talk just the quarterly numbers. I'm here to discuss the main takeaways. And to me, the biggest headwind to Microsoft's AI ambitions is not DeepSeek. It's not the DeepSeek saga, which you guys are all familiar by now. But rather ironically, what was once the company's biggest AI tailwind, its partnership with OpenAI. With the launch of Stargate, a $500 billion, $500 billion joint venture between OpenAI, SoftBank, and Oracle, Microsoft will no longer be the exclusive cloud provider to OpenAI. This is hardly surprising, given that the two companies whose partnership kicked off the AI revolution have been at odds over the capacity constraints that have plagued Microsoft, which made it unable to fulfill OpenAI's demand for computing power. Moreover, both companies had planned to build their own supercomputer for training OpenAI models, but it never materialized, at least according to a report from Wall Street Journal. More recently, OpenAI has been getting closer with SoftBank, who plans to invest as much as $25 billion in the ChatGPT parent in a $40 billion funding round, which would make SoftBank OpenAI's biggest investor, dethroning Microsoft. And then earlier this week, there was more chaos as a consortium of investors backed by Elon Musk made an unsolicited $97.4 billion offer for OpenAI's assets. By the way, a little update on that, a bid was outright rejected by the board. And since then, we've not had any we have not heard any stories. I mean, Mr. Musk at the time released a statement saying that the bid would be withdrawn as long as OpenAI stays a non-profit company, but the board categorically unanimously rejected the bid of 97.4 billion and nothing more to come of it. I mean, obviously, it could have forced the board to reassess the valuation of the nonprofit while having to simultaneously assess how much equity Microsoft would receive in the for-profit entity. Simply not happening. But what is happening is SoftBank's $40 billion funding round, leading with $25 billion investment, is still on track to happen. So OpenAI's bid, Elon Musk did try to throw a spanner in the works. Didn't materialize, board completely rejected. And I think Mr. Musk has got enough troubles on his plate right now with regards to Tesla and the backlash he's receiving as a courtesy of his Doge activity. So since then, I've not heard anything with regards to what he does plan to OpenAI. But this is Elon Musk, guys. Expect the unexpected. Anyway, all these developments are not just distraction for OpenAI. Even if the bid failed, it still continues to be a distraction, not just for OpenAI, but by extension, it is also a distraction for Microsoft. This therefore calls into question how long can Microsoft keep benefiting from OpenAI's partnership. Whether the tech giant likes it or not, a significant portion of the company's AI-driven Azure growth is attributed to the partnership with OpenAI. For instance, in the second quarter, Microsoft's broader AI business generated a $13 billion annual revenue run rate, which translates to a whopping 175% year-over-year growth. Furthermore, AI's contribution towards Azure growth also ticked up 13% in second quarter and has been showing incremental growth with each passing quarter. These are impressive numbers in my opinion, and it justifies the company's massive spend, which accounts for 30% of its annual revenue. That is not the issue. The issue is not the 30% of the annual revenue and CapEx spend. The issue is that given the chaos and confusion surrounding OpenAI, I am simply not sure whether the growth in Azure's AI business can be maintained. At a crucial juncture when the partnership just had started to pay off, not only are cracks forming in Microsoft's partnership with OpenAI, but the company's once trusted partner is also going through a period of chaos. Microsoft's stock tanked more than 6% after its earnings release and has been on a negative downtrend. Negative downtrend? That's a double negative. Has been on a downtrend ever since. And while the decline can be mainly attributed to a slowdown in Azure growth and a disappointing revenue guidance as a result of stronger dollar, the bigger concern for me is that the company's massive capex spend may not translate into meaningful growth in the future if the OpenAI partnership falters. And unlike its peers such as Meta, Amazon, and Alphabet, Microsoft significantly relies on third-party partnership to grow its AI business. One could argue that Microsoft has opened up GitHub Copilot to other models, such as those from Anthropic and Google, but the foundation of its AI business, whether it's Azure growth or Copilot, remains dependent on OpenAI. As such, the future of Microsoft's AI-driven growth could take a turn for the worse should the partnership with the ChatGPT parent disintegrate. The stock price has also been reflecting this, given that Microsoft has been the worst performing stock among its peers since that particular earnings release. Alphabet is slowly catching up, by the way. More on that at a later point in time. I will be dissecting Alphabet as well. Now, ever since the arrival of DeepSeek, questions have been raised about the massive capex spending by big tech in the United States. In my opinion, the spending is justified as we move from model training to inferencing, and as we move from generative AI to artificial general intelligence or AGI. Having said that, among all the big tech players, Microsoft to me looks the most vulnerable as far as future growth is concerned, given how its once trusted partner today has simply become a distraction. Got the book ready? Got the pen ready? Let's talk about valuation. Now, Q2 revenues came in at 69.6 billion, marginally higher than the higher end of the company's guidance of 69.1 billion. This takes the company's combined revenues for the first half of FY25 to 135.2 billion. Okay. Q2 revenue growth came in at 12.3% year over year, and during the earnings call, management, as a result of the stronger dollar, expects Q3 to take a 2% hit year over year compared to the company's previous estimate. As such, the company now expects revenues to come in between 67.7 and 68.7 billion. Assuming the company hits the higher end of its guidance, $68.7 billion, which would translate to a year-over-year growth of 10.9%, slightly lower than my previous estimate of 11.4%. Now, I'm going to assume the same 10.9% year-over-year growth for Q4 as well, which would result in total combined revenues for second half of FY25 would be a 140.5 billion. And now that total revenue, this means that the total revenue FY25 would be 275.7 billion. Okay, there you go. So basically total revenue FY25 275.7 billion translates to a year-over-year growth of 12.5%. Now, management during the earnings call announced they expect FY25 operating margins to be up slightly year over year as a result of the operating leverage that they have delivered throughout the year. Now, assuming operating margins for FY25 to stay at 45%, which is the same as Q2 and a slight increase from FY24, FY25 operating income would be 124.1 billion, higher than my previous estimate of 120. So FY25 operating income, 124.1 billion. Now, the company generated other income and expense of negative 2.3 billion in the second quarter as a result of the impairment charge from its cruise investment. The company now expects other income and expense to be negative 1 billion for Q3. I'm maintaining the same figure for Q4 as well, results in total other income for FY25 to be negative 4.58 billion. The brackets indicate the negative. Yeah. So total other income would be negative 4.58 billion. And then that means that FY25 net income comes in at 119.52 billion. Okay. FY25 net income 119.52 billion. Now, assuming an effective tax rate of 19%, effective tax rate of 19%, and that means that FY25 net income after tax would be 96.81 billion. Okay, FY25 net income after tax 96.81 billion. According to Q2 press release, the diluted weighted average number of shares stands at 7.47 billion, which results in projected FY25 EPS of 12.96. FY25 EPS of 12.96, which amounts to a year-over-year growth of 9.83% and is higher than my previous estimate of $12.48. Now, according to LSEG data, the company currently trades at a forward price to earnings of 27 times, marginally lower than its 2-year and 5-year historical median forward PE multiples. The earnings growth for FY25 is expected to be lower than the long-term average, and there are concerns surrounding the Azure growth as well as its partnership with OpenAI, as I've mentioned. As such, I've assumed 27x as my forward PE multiple. So 27x is my forward PE multiple, and FY25 EPS is $12.96. Now, the company, according to Seeking Alpha, currently trades at a forward PEG ratio, which is price to earnings to growth of 2.4x, slightly higher than its 5-year average of 2.34. Now, last time I talked about Microsoft, I was of the opinion that earnings growth would pick up based on my assumption that AI related spend would come down, thereby boosting margins. However, during the second quarter earnings call, management hinted that FY26 capex spending is likely to be at the same level as FY25. Furthermore, as mentioned earlier, skeptical of future Azure growth given the uncertainties surrounding the OpenAI partnership. As such, I'm going to assume a forward peg ratio of 2.4x for my calculation, which results in earnings growth of 11.9% and which will lead to FY26 EPS of 14.5. Now, here we go. So you have 27 times forward PE, multiplied that by 14.5, and you get a price target of $392, which is around the levels where the stock currently trades. So here we go. So you have 27, the PE, 14.5 is the FY26 projected EPS, get a price target of $392. The new price target is also lower than my previous price target of $423. Given the upside from given the limited upside from current levels, uncertainty surrounding the company's growth catalyst, as well as a weak momentum grade, it has a grade of C on Seeking Alpha's momentum scale. I'm maintaining my hold rating on the stock. So price target of 392, lower from 493. So price target of 392, it's a hold rating. It's lower than 423, but it's exactly where the levels are currently trading. Bottom line, ladies and gentlemen, Microsoft had a very good quarter overall. Despite a slowdown in Azure, the encouraging news was that the contribution of AI towards Azure growth incrementally increased and is on an upward trend for now. Having said that, the non-AI businesses of Azure underperformed and management's Q3 guidance fell short of estimates primarily due to a strengthening dollar. To me, ladies and gentlemen, however, the biggest concern right now surrounding the company is how its once trusted partnership with ChatGPT parent OpenAI, which kickstarted the AI revolution, is at a crossroads and is fast becoming a distraction. Ever since Sam Altman announced that OpenAI is exploring ways to make for a for-profit entity, uncertainties have sprung up. The latest being the now failed $97.4 billion bid from Mr. Musk and team. At the same time, Microsoft will no longer be the exclusive cloud provider, and is also on the verge of being dethroned as OpenAI's biggest investor, with SoftBank considering a $25 billion investment. All these distractions are coming at a time when Microsoft's AI business is finally starting to justify the company's massive spend. What an irony. What happens in FY26 and beyond will depend on how the partnership with OpenAI evolves. At a time when Azure growth is slowing and the non-AI businesses is underperforming, the last thing Microsoft CEO Satya Nadella needed was a headache from his company's once biggest catalyst. Unfortunately for him, Mr. Altman is exactly giving him that. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose or dissect, do tweet me at Uttamvinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I will see you next Tuesday. You guys seem to like the Tuesday episode, so I'm going to keep it for Tuesday for now. Until then, ladies and gentlemen, stay safe and make some money.